Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're just going to look at inflation, deflation, stagflation, hyperinflation. What is the right answer? Is there a right answer? And what is the data showing? So we've given presentations before about, what our views are and kind of where things are headed. And just to give you the cliff notes up front, the view is that we're going to reach a stagflation point where we're going to have pockets of inflation, pockets of deflation, which will net out. But the US dollar won't lose its reserve currency status. It's too ingrained. There's too much of a shortage on the international level. And that's something that we're going to talk about at the end. So the way we're going to look at this is, what are some of the inflationary pressures? What are some of those deflationary pressures? And what happens to the US dollar as a whole? So just to kind of jump right in here, these are just some Powell quotes of just comments that he's made, kind of giving us this view where monetary policy will continue to be easy. There's really nothing to stop where this is going. And then the other bigger component is the changing around what is deemed inflation levels. So typically they've held true to the 2% target. The commentary now is they want to average 2%, which means that there will be periods of time where the Federal Reserve will be okay with something well above 2% to get to an average, which it can be a little concerning when you consider pricing and where things are shifting. And when you look at gold, when you look at oil, when you look at commodities in general, you can see that there is this challenge back and forth. And it's really always driven based on what is happening with the dollar. So we normally don't give price targets. We don't really like to give too much of that kind of color. But one of the things here is the US dollar is really on a trajectory to those mid to upper 90s. And the reason why is because there still is this shortage abroad. There still is this demand for US dollars, which is keeping people coming back to the US, sourcing this on the euro dollar side. And, when we're talking about the euro dollar, we're looking at what is happening in the international markets in terms of foreign reserves, which is going to be a big talking point. So at any point in this presentation, you have any questions, please feel free to reach out, because we're going to start talking about some terminology. I'll try to keep it as high level as possible, and we'll keep following up on this as we continue to go forward. But the dollar is going to be kind of that structural component that we'll always look at. Oil typically, as the dollar rises, oil and gold fall. But the problem here is oil has very specific supply-demand fundamentals that are outweighing the inflationary pressures. And then at the same time, you have a dollar shortage on the FX side when we look at OPEC and a lot of these other nations, which is going to continue to keep that US dollar flowing out and having that demand, keeping that bid within dollars overall. So that's why we're going to keep looking here. But even as the Fed tries the monetary policy overwhelm, it's just there's too much of that demand on the back end, which is going to send us higher, but will put additional pressure on emerging markets, which will be a big focal point going forward as to when the dollar could actually come under significant pressure. And it would really come from emerging markets essentially saying, look, I can't pay this debt. I have to get out. And there's going to be some sort of default or some sort of haircut taken. And that would unleash a certain amount of dollar demand. And that's why but before we go into that, we have to look at what's happening within the U.S. What is happening on a municipal level, state level, on and the federal level. And here's just one view of personal income. And it's just when we think about the velocity of money and how does this get through the system. And don't worry, we'll go through the velocity of money a bit deeper. You can see that personal income had a big spike as we had a big fiscal response of $1,200 into the market, $600 of additional unemployment, and then obviously the 300, but that has come off. And you can see even before we got into 2020, the growth of personal income was on a downward trajectory that peaked in 2018. And if you've watched our previous shows, or if this is your first show with us, the thing that we always have talked about is 2018 was really the peak of economic growth. And then we started to see that bleed down in 2018. And then 2019, you saw PMIs, ISM, GDP, all of these, key indicators. With the ones that we were looking at the most was distillate and global trade started to really come off. And that really reflected in that pressure. Now, when we turn to the numbers from today on core unemployment, you can see that unemployment is continuing to rise on that U5 minus temporary unemployment. So we're trying to really kind of pull out and say, where is real unemployment? Where should it be? And what is the trend? And you can see the trend is moving upwards, which again will put additional pressure in terms of, well, even if you have that personal income, what are you willing to spend? And when we consider spending, it comes back down to getting money into the system and trying to push it through to keep that velocity up and running. And here's just a good kind of backdrop of the chart on the right looks at just volatility. And when we look at currency volatility, we see that it's actually flipped above just the way the volatility index on the aggregate looks. And the volatility continues to worsen on a currency level. We've seen it in the Turkish lira, in the Russian ruble, in Brazil, in India. There continues to be this stress on these different foreign currencies, and it comes down to shortages of dollars because they're seeing their foreign reserves bleed down, and then there's this rising fear of their inflation, which is why Turkey had to have an about face, raised rates to try to protect the lira. And here on the one on the left is looking at that sensitivity to global growth. And that's why we talk about, Brazil, Mexico, Turkey, South Africa. These are key areas that are going to have some movements that we need to look at. And China is a big one, which we'll talk about at the very end in terms of, the correlations that we're seeing and the issues that are being relatively pronounced as the volatility increases. And that volatility, again, will push you to safety. So that's why we continue to see this perpetual bid that is keeping the dollar from breaking, because we've seen a huge amount of people going short. We've seen people saying, no, the dollar's going to break, the dollar's going to break. And these are some dynamics that are just providing this underlying bid that is really offsetting any of that downward pressure. But the downward pressure still remains. And this is something to think about when we look at just like the budget balance and how, we've talked about so much in the past, how there has to be we have to see an increase in treasuries. We have to see an increase in borrowing. And this is not just in the US, this is a global problem. But the US happens to be the largest in terms of our budget deficit that has to be closed, because we came into 2020 with a steep budget deficit, which only got exacerbated with COVID-19. So here is just one of those things where when we look at the curve and the overall demand for actual bonds, we're seeing this bid that's coming into more of the 30-year, and it's because of the inflation expectations that is being baked in, where duration is becoming a problem. And when we talk duration, we have T-bills, that's monthly, that's a monthly thing. And then we have the 10-year, the 20-year, the 30-year. So as we go further into the curve, there's more of a concern of what will inflation be in the future. And that's going to price into the top end, which is going to provide a little bit of a bid, which comes into bid to cover, which we'll talk about in a second. But the chart on the right looks at the different backdrops between nominal, which is what is quoted, which, we're still in a positive territory. We don't have negative rates. But then the real is when you factor in inflation and the nominal. So that means that we actually still, on a real level, what you're actually going to earn once you factor in inflation is actually going to be below zero, and something closer to, negative 1%, which is going to, again, that's why we already have negative rates, which if you think about it on a real level, and that's why when you look at the negative nominal rates married in with inflation expectations, you see that push going even lower. But we still have a relatively strong capacity in terms of other countries, which is why, again, in order to buy U.S. treasuries, you have to have U.S. dollars, which, again, putting that bid back in the dollar right there. So now when we look at the curve, this curve is from yesterday, so you can kind of see where things are. The 30-year did come down a little bit. The 20 years come down. But you can see that there's the steepening of the curve continues to remain and the idea is, what about a bearish steepener? And when you put on that trade, you're going long the front month and you're shorting the back month, with the idea that prices will fall as pressure comes in and the yield goes up. Because remember, price and yield are inverse to each other. And the reason why we look at that is when we look at indirect bidding and bid to cover. So when you look at bid to cover, it's the ratio of amount of people that are willing to come in and want to buy the bonds themselves. And there's international, there's direct, and then there's indirect. And when we look at what is the indirect bidder, you can see that based on the tail or where it gets filled is really being dictated based on what is that indirect bidder. And we continue to see the indirect bidding come down, and it's really going into the direct market. Now, that hasn't been a huge issue yet because the Fed has quickly showed up and has been willing to buy that other side of it, where they issue it, then they're coming into the market to purchase it. And this is something where it's skewing the market, but I think that you could get a really big shock to the market if we have a bid to cover fall below 2. And that's going to be something to watch, because the 10-year has been okay. The 30-year has seen a weakening of that bid to cover ratio, and it's perpetually gotten a little bit worse, which again is something to watch when we consider what is that inflation expectation. And that's why when we look at inflation expectation, it's always good to look at TIPS, which are just treasury that has inflation protection attached to it. And when we look at the swaps, you can see that they've come down a little bit after a strong rally, because some of the expectations of inflation in the market has started to die down, even though there's still a growing view that inflation will accelerate, but it's pared back a little bit, and we have to consider why. And even though we've had this expectation rise, the Fed is trying to jawbone us higher, where no, we're going to have inflation, don't worry. And when you look at that chart to the right, they're actually buying TIPS. Now they're actually the most aggressive in purchasing these TIPS. And the question is, are they doing it because they know inflation is a real problem, or are they doing it to give the view that others believe inflation is coming, so that's why you want to do it? And it's kind of a catch-22, because if they own the TIPS, so if they own the bonds, they don't have to pay that difference. They don't have to pay for if inflation comes up, because then that increases their overall cost when you're thinking about the treasury. So that's why there's this weird conundrum of, who's buying what, where are they buying? And we've actually seen an increase in the amount of, we saw an increase into ETFs that are inflation protected, and then we had a huge drawdown. And again, it comes down to who's doing what are people projecting? And here, when you try to sift through the noise and you look at that inflation swap, you can see that it's starting to creep higher. So I think that there is a little bit more of a concern that inflation is starting to tick up, and the inflation is going to be driven from a broad standpoint, from offshore versus onshore, based on where the economics are. But with that being said, the ETF flows had a big change, where we had a big increase in inflation fears, which started at essentially the beginning of March, when the Fed launched their nuke to increase the amount of protection in the market. But now we had a big drawdown. Now, this could have been a rebalance because they see some other opportunity and they're shifting the way things are going. But this is going to be something to keep an eye on, which we will continue to do, to look at where are ETF flows going? Are they going in which direction? What are people starting to price in? And right now, I'm going to say that this is more of a rebalance, given where things are from Q1 into Q4 and as they prepare for 2021. But this is going to be something, because I very well could be wrong. This could be a meaningful move where people are really coming out of inflation protection and going aggressively into other parts of the market. But right now, this is just an interesting data point that we have to highlight here. Now, when we look at how is this backdrop shifting in terms of personal consumption, and what does personal consumption look like, and what does the core inflation rate starting to show? So the one on the left, that chart on the left, is the one that we already talked about, where we have budgets, the huge shortfall, a need to issue new debt. But when we look at the Fed funds and we look at the US Treasury, 10 years specifically, and inflation, you see this downward move. So from 1995 into today, we see this huge move down, and it's really because the velocity of money has come under significant pressure. And the pressure has been created because the money supply keeps growing, which is the denominator, but GDP growth just isn't matching where those prices are. And it's really because there's a bottleneck in the system, which we'll talk about in a minute. But that's really capped in where that PCE inflation is. Now, when you also look at how does the Fed and does the US government really calculate inflation, it's really a flawed model, given it doesn't give the proper weight to what people are actually spending and how their income has adjusted, not only in terms of the amount coming in, but also what is the replacement value, and then where are real costs based on what's being spent and what's being avoided, which is, if you go through some of our other shows, we've talked about food, we've talked about some, obviously we talk about energy, but food has been a big one in terms of where that inflation is really starting to garner some interest, and you're starting to see those prices reflect that on a global level, not just in the US. Now here, when we go, the one on the left is looking at where is the actual number coming in. And you can see that we've had a big spike, and it's remained fairly elevated, where it came in at 0.6, then it came in again at 0.4. And this is not something we've seen since the 90s. And it's really the highest level since 1991, which is putting that fear back into the market in terms of, well, how are we looking at inflation, and what is the core inflation value? And when we look at the stimulus that has come out, when we look to the right, that is really that shortfall that has been created, that we have to make up that number. We have to, close that gap. And if anyone who's been paying attention to the $2.2 trillion that was passed the House, it won't pass the Senate because it's not bipartisan, it's just one-sided. There's going to be more fiscal stimulus, whether it happens before or after the election. It's going to come, which is going to increase that decline. And as that decline goes through, well, what are people going to do with that money? Well, apparently they're going to spend it. And as they spend it, it'll push it through the system, because they're changing how it's entering the market, which is something that we're going to focus on in a little bit in terms of the Cantillon effect. But here is just a big thing to look at in terms of, well, what is happening? How is it happening? And here you can see that there's been that increase, and we think that there's going to be this stickiness in that inflation view, especially as we look at core inflation. And then we think it'll increase as we factor in the energy. And energy in a different way. But again, we'll get through the nuts and bolts of that. But also food. Food is going to be the one to watch, because there's a lot of shortfalls in the market that really aren't appreciated and are only starting to now really pick up. And when we look at how does this look on an unemployment level, it's going to come down to, well, how willing are people to spend? How willing will we get some of this stuff through, as we see in price increases in one side, price decreases in another? And again, that changing consumption is going to adjust how inflation really appears in the market. And that's why when we look at the distribution of unemployment, you can see that there has been a huge spike in the amount of time people are unemployed. And you can see that big move in 15 to 26 weeks, the big move in 27 weeks and over. So 27 weeks and over is now has gone from 12% to 19%. 15 to 26 weeks is now at about 54%. So just think about the longevity, and the longer you're unemployed, the less confident you are that you're going to get a job quickly. Based on what you're seeing, we're heading into an election year, in an election cycle. There's a lot of concern, and the uncertainty of who wins because of tax policy, corporate structure, keeps people on the sidelines until they have more clarity, which again is going to put stress on the balance sheet for people themselves. And that's why when we look at the inflation measures, you can see that pop. But again, that 2% is where they're looking to head towards. We think that we're already above that 2%. It's just the way people are spending is putting us above that. But if you look at it as an aggregate, the way they've calculated it, we can see that this is fairly true in terms of what they're saying. It's just we think that the pain is actually much worse on the consumer level. And that's why, this was a chart that we had used previously, because it gives a great backdrop of the medical care. You're staying at home, so what are you going to spend more on? Well, you're going to get an extra satellite or cable package because I need more movies because my kids are home or I'm home and I want something to watch. Food at home, recreational books like rent. So where do we see the biggest increases and rises that are going to continue? One is medical care. Two is food, as we've talked about, where people are buying more food for home, but the prices are going up. And then rent and mortgages. Now, rent and mortgages, there's pressure on the downside. And that's where this gets interesting in terms of where does that inflationary pressure come from? Because we've seen people that have essentially bid up housing where they've bought a bigger house because the mortgage rates are so low. So if their prices were higher and the mortgage rates were higher, then people would just shrink down. So realistically, that mortgage rate is kind of where it was going to be in terms of what people can actually afford. The other issue is the first movers are gone. So now you have people that could buy homes, have bought homes at elevated prices because we had a shortfall of supply. We have a delay of delinquents of short sales, or as delinquencies have risen, we still haven't had people get kicked out of their homes. And here you have this weird backdrop where people wanted to flee from the urban areas, and that's why we had these big price increases. But mortgage rates are starting to, even though they're falling, we're seeing a less likely ability to lend or people tightening. So one of the anecdotal things, which is actually starting to show up in the market, we've been talking about how banks were actually tightening their requirements. And by tightening their requirements, that means that we actually saw less mortgages get approved or getting approved for a much lower rate, a much lower quantity, which is also delaying some of these sales. But that is something that we're going to look at a little bit deeper. But again, those are things that we were expecting to see, and now it's starting to get a little concerning, and some of those prices will start to come down. But the stuff that we don't want is cheaper. Again, how people are changing their spending habits, most of that is going to continue to fall, except for that food at work or school, because restaurant food prices are also starting to go higher. So that will creep up. But it's just people aren't spending as much, so they have to try to bring down prices to incentivize people to actually purchase. Now, when we talk about the entry points, we call out the Cantillon effect. And he was back from the 1700s. He had a lot of influence in terms of some of the modern day views of the money supply and money flows. The biggest component is he really highlighted where does the inflation appear, and it can appear in pockets, and depending on where the money is actually entering the market. So one of the bigger things that we've been talking about is it's been hitting the banks. So the banks have been selling their treasuries and they're selling bonds, especially mortgage-backed securities, back to the Fed, collecting dollars and then doing nothing with it, because they're essentially sitting there saying, I don't feel comfortable lending because I don't see a lot of value, so I'm going to keep it on my own balance sheets because I have rising bad debt. And the rising bad debt is because corporate loans are going south. You're starting to see, again, the delinquency rates going up, so they have to backstop some of the problems in these mortgages, which, again, is keeping the money locked within the actual bank instead of actually moving through the system and getting that velocity going through. And that's something he's done Cantillon has done a very good job at, where especially if the money is out there, you can raise prices ahead of it. And you can raise those prices so as the money does come through, the price is already reflected. Because typically the way it goes is if I get an extra dollar that wasn't expected, I can then buy more stuff because the prices haven't moved yet. So instead of buying 1 gallon of milk, I'll buy 2. And then as my demand for that milk goes up, the price will go up. And then I'll be back at $1, a 1 for 1 instead of a 1 for 2. The issue here is we see it coming and then the commodities are pricing that in. So even though I'm getting an extra $1, I'm not able to buy anything more. If anything, I'm actually buying a little bit less because we do have some inflation in pricing if we look at, on foodstuffs. So the idea is, well, if I want to adjust this and really accelerate, well, why not give it directly to the people? As we saw with the $1,200 stimulus, what it did to consumer spending, to pay down of debt. You saw it instantly come through. The other issue is, speaking of pay down of debt, debt is deflationary, because when you look at the debt levels, which is on a global level, all-time highs across the governments, consumer and corporations, if you take a dollar and pay down debt, well, it has no real velocity. It's just dying there because banks aren't turning that through. So again, it comes down to how do we adjust the entry point. And one of his points was, well, if you give it to the entrepreneur and not the property owner, well, then the entrepreneur can then buy more stuff from the labor side, from a goods side, and then it would be able to move more, have more investment, and then that would accelerate where the property owner could decide, I'm just going to sit on it and I'm going to increase my own personal wealth and not enrich anyone else's. And these are different components in terms of, well, where does it enter and how does it flow through? Clearly, we've shifted in terms of who is a property owner, like who is the service provider. But it's an interesting conundrum as to the acceleration of the dollar, which you could argue would be better served through the people versus through banks. But again, that's back to that bottleneck. And that's when we look at the velocity of money. And this is where we look at V equals just price times a GDP unit divided by the money supply, or in this case, M2 for our discussion. So M2 is just the size of the money supply, which continues to grow exponentially. As you can see here, it went up again because it did get updated, I think it was yesterday, in terms of what the volumes are. But you can see velocity has really had that downward move, which started well before, right around 2000, and only accelerated to the downside as we saw rates getting cut. Bernanke is not the first one to do it. Neither was Yellen. Neither was Powell. It really originated with Greenspan. And you could say that there was discussions before that, but Greenspan really pushed the low rates for a long period of time. And that accelerated the debt cycle where people just started borrowing and borrowing and borrowing. And again, that debt is deflationary at this point. And that's why if you default on that debt, or if that debt goes away or gets cut in half, all of a sudden you can get a big pickup, which is something that we continue to talk about. But also if you change the direction in which it's entering, where if it goes to the consumer versus the bank, do you get that acceleration through? And when we look at that race to the bottom, it's not just us. Everybody has been moving in the direction to negative or zero rates, because it's a matter of who has the ability to do so. And because we are the reserve currency, even as the dollar has strengthened, other currencies have weakened, as the dollar has weakened, other currencies have weakened more. So even though we've gotten this push down, other currencies have pushed further down. So we're still outperforming about 96 global currencies, which again is keeping us within this position. And that's why we continue to see these problems, because everybody's doing it at the same time. So you're getting this flood of monetary policy, but it's all sitting at the banks with no real projection going through, which we've seen with social discontent. We've seen with lack of social mobility, because companies aren't investing in processes, manufacturing, supply chain. They're investing in issuing debt, buying back equity, and trying to make a artificial alpha in terms of financial means. But again, that doesn't generate jobs. That doesn't generate where we need to be to get out of this zombie or stagnation that we're continuing to see, or what we like to call the Japanese effect. And by us, it means a lot of people outside, in the world, in terms of the Japanification, or the Japanese, let's just say the Japanese model. And here is just when you look at the monetary policy flowing through. This is just looking at the Fed, the BOJ, and the ECB, and you can see that it just continues to move upward. If we look going forward, we don't see that stopping. So this is why we continue to see that commentary of eventually inflation is going to show up, because look at how much money is being pushed into the market. It's always going to be a matter of where does the floodgate open? How does that floodgate come through? And that's where we continue to see this friction point of, well, where are we going to see that acceleration? And here's where you look at the GDP percentage. And when we talk about debt weighing on general growth, you're essentially pulling forward what you thought was going to be growth, because this is going to be a long-term overhang. And that's why when we look at that BOJ, you can see that they've been in this stagnation for an extended period of time, as they're 136% of GDP. The Swiss National Bank is 152%. So just think about the weight that that's going to put on the overall economy, because you've already issued debt, you've already tried to stimulate as much as possible. And here on this regard, and this is something Powell's probably looking at, the Fed has a long way to go. So you could say the Fed has a ton of running room if you consider what they could do to try to push this through. We just have seen that there is an unwillingness of the consumer to move the value through. The banks unwilling to lend, which again is becoming a much bigger issue, because there's a bifurcation in the market where the top 1 to 10% are doing okay, and that bottom 90% is being left behind. And that, again, you need that bottom 90% to really feel the effect, to push through and feel better about spending money, which again is acting as that deflationary pressure. And this is the other interesting thing when we look at people buying things in stores. We have rates going up, and especially on a 2-year freight rate, on the cost of moving stuff. So even though we have less things moving through the market because there's less demand in the market, and by less demand, you can't spread the cost across more items. So cost increase. And then you have competition as demand rises for trucking, which is pulling rates up. Now, mind you, rates are going up because of demand for trucking, not because of diesel, which is why when people talk about wanting higher oil prices, well, that's going to make your diesel more expensive, and those will go parabolic, and your costs will go up. The other side is on the container side. Those prices have gone up not because there's a huge amount of demand, but there's a huge amount of bottlenecks in the global supply chain on the shipping side. You can't backhaul freights. There isn't enough containers at specific ports. You can't switch your sailors because people won't let you on shore because of COVID fears. So this is pushing more into the market, more ships into the market, even though there's not that demand, and you're getting more pricing because of that, which again is increasing that cost, which when you look at what the U.S. has done, which we've talked about multiple times in our trade segments, where the U.S. is increasing their imports and you're seeing pressure on the exports, which is widening our trade imbalance. And it's because of the cost coming in, where we're just spending more dollars to bring it to shore, and we're trying to shore back up the supply chain that had huge disruptions, because at-time deliveries created this shortfall in terms of cushion. There was no longer inventory cushion, or at least not inventory cushion like we've had in the past, because at-time deliveries became a thing to try to streamline and cut costs. Well, it cut costs most of the time, except for things like this, which is a global upheaval, which again is going to only increase your costs on a go-forward level as you try to rejuvenate. Now, that's what's causing some of these individuals, these different companies, to increase their overall expectations of inflation. Now, we also believe that inflation is going to have an upward movement, just given where we think the disconnect is. But this just gives you an idea of what Morgan Stanley is starting to expect in terms of some of these shifts higher on the forecast. Now, anybody who's been paying attention to the bond bull market for the last 20 some odd years can tell you that most of these have been wrong. And the question is going to be, well, how do we know when they're going to be right? What are we looking at? And that's why we look at multiple data points to try to triangulate, well, is this really real this time? And at this point, we do think that there will be inflationary pressure. But again, there's going to be that offsetting, which is going to create that stagnation. And here's another view in terms of on the market implied side, looking at what are some of the BlackRock estimates. And they're very similar to what Morgan Stanley's saying of, we're going to get over that 2.5%. And when we look at the inflation expectations, well, how do you play that? Like, where is the opportunity? And the frustrating thing for me is when people call it Dr. Copper. Dr. Copper doesn't exist when Mr. Copper doesn't have the right amount of supply because of COVID, because of strikes. So it's not a demand driver. It's the fact that there is no supply. So if there's no supply, prices are inherently going to go up, because you still have a certain amount of demand, which is going to be filled somehow with a shortfall of a massive disruption. Now, as we've had mines come back online, all of a sudden prices have normalized. Again, that isn't because demand surged and fell. It's because supply rose and fell, which if we think about what this means, it means that we're going to get additional inflation, especially if we look at raw materials. Nickel is another, especially if you start believing in the EV battery integration, because there's only a certain type of nickel, which is about 30 to 40% of the nickel market, that can actually be used in batteries because there's a quality disconnect. So those are things that are going to continue to come in. We remain fairly bullish gold, with the idea that gold is going to be a value proposition, because even though it technically yields zero is still higher than negative real yield or or negative nominal yield, which if you factor in, the real, it's even further. So that's why gold, we think, is going to have that power to the upside, even in a deflationary cycle, because there's just going to be fear, because deflation will be created by just essentially a 1929 effect, where the lack of jobs, which we've been talking about as moving to a leading indicator, is going to weigh on just general spending, which again is just going to create that fear. And if you consider how are countries going to backstop their balance sheets, their own currencies, we think gold is a big answer, because people will push back and say, well, India is not buying as much gold because of wedding season. It's like, look, if you think a guy getting married who's rich buying $150,000 worth of gold is going to be a bigger effect than a central bank buying $1.5 billion worth of gold, well, we have very different views of how the market works. And that's why I think central bank purchases is going to be what to watch when you consider how high or how aggressive is gold pricing going to go. And that's when we look to those other inflation targets on a 3-year average as we look towards other entities. And you can see that, again, the market is starting to expect that. And because the market's expecting that, you're seeing prices reflect that, even though it really hasn't appeared yet in terms of getting those additional dollars into the system. So again, prices moving ahead of it. As you can see on the right, the GS Goldman Sachs has that expectation. Now, they have a quick spike and fail. Now, that's different than some, again, always looking at different data points and different views to see who has a better handle. I think what Goldman is saying makes a little bit more sense. I don't see that real collapse. I think we get a big spike and then we kind of hang out at the top and then start to come off as some of those deflationary pressures start to work through the system, which I think is going to be a bigger issue in 2021 as the joblessness is maintains. If any stimulus comes in, it wears off quickly, as we saw in April. And those are things that are going to be that deflationary side to the equation, even though we have those inflation pressures on the tailwind side. And here's the interesting thing when we look at T-bills outstanding and how the Fed is really looking at this. Now, the Fed has been a big buyer of just stuff, across the board. And here on the right, you can see on how, the blue line is the foreign holders of treasuries, which continues to go down because people are, and by people, I mean governments are looking to pull forward dollars. So they can't wait for the payout of interest because they need the principal. They need the money right now. Or JG Wentworth, give me my money now because I need to shore up my balance sheet because I am concerned about my foreign reserves. So that's where you're selling, and the Fed has been happy to come in and buy up and absorb that additional volume, which again, like people have said, oh, look at China. China's trying to damage the US by selling $200 billion of treasuries. No, it is complete fallacy, and that is some foolish spin. They need that money in order to shore up their balance sheets. China is in probably the worst position when you consider leverage, balance sheets, and other. And just, I'm saying that by sheer size, because you can make an argument Turkey's worse, and it's fine. I won't fight that. But China itself is in a significant problem. But now when we look at the bills outstanding, the Fed essentially is just getting new volume to buy on a regular basis. And the question is going to be what happens if they have to stop or if they have to pivot. That'll just put additional pressure into the market. Now, this is just an example of how things can go parabolic, lumber being one of them. Here you had a big rise up. You had essentially for 2 months, you went limit up. And for those that don't know, limit up just means that the stock market, or I should say the exchange here in this case, has a limit in which it can move in any given day, and then it's done for the day. And so when you go limit up, you've reached your top. Limit down, obviously the opposite. So you had 2 months of limit up, And you had 1 month of limit down. And these are the parabolic moves. Now, this is, again, supply driven as well as demand driven because lumber futures are very specific lumber. It's framing lumber. And if you look at just the shortages in the market and then these huge demand for new homes, renovations, anything from sheds on up, this has been a big driver. And this is also going to increase price. So again, coming to those inflationary pressures where prices are inherently going to go up. And then the question is, can you afford it? And if the short answer is the people who can afford it already did it. On Thursday's show, we talked about the searches for cars. There's been a slowdown in those searches because people who could buy cars have bought them. Now you're seeing a pressure in terms of people globally searching for cars. The Google trends has gone down because people no longer have that spare capacity. We've seen it in consumer, in durable goods, where we see that kind of pressure coming in because people who could buy have bought. Anyone that was delayed purchasing because of COVID has now made that up. And that's why we had a big surge. And now we're going to start to see pricing come down. And it's the consumer confidence is one of those interesting ones where I can't make this one pretty because right now consumer confidence is really separate from the other data points that are in the market. And this is why I want to call this one out because we're seeing an increase in consumer confidence, even though there has about a significant amount of headwinds. And the interesting thing is the consumer confidence is on the under 15,000. You can see that there's additional headwinds there, again, coming to the top 10% being okay and the bottom 90% not. So there's still that concern at the bottom level, but you're starting to see people feel a little bit better at the top side. And that's going to be something because when you think about who still buys a lot of stuff in discretionary income, it's that top level. So again, this is something that is going to run a little counter to some of the things that we're seeing. Now, we think this levels out and comes further down to where the rest of the economic data is shaking out. But again, an interesting data point. PMIs have been fairly supportive of some of this on the manufacturing side, not so much on the service side. But again, that's also starting to normalize as people go back to as new furloughs and new layoffs are announced. And this is going to put some of that additional pressure specifically on that confidence level. And this, again, comes to that delinquency side, because when we look at the volume that's going to enter the market on the housing side in 2021, you can see that it's fairly aggressive, especially when you look at 90 days, because a lot of those 90 days are going to become go into the foreclosure process. And here, you just have the delinquency rate coming down, and typically home prices follow that. And here, home prices have remained elevated. And the idea is that home prices will follow. And as that follows, people will borrow against their houses. And that they'll do that in multiple different ways, whether it's a second mortgage, a private equity, a home equity line. And as the home price falls, and then you have more debt than what the home is worth, that's called being underwater. And when you're underwater, that's when you start to see pressure in terms of, well, what are people going to spend? How are they going to spend? And again, these are those things that we think home prices will start to roll over in 2021. And that's going to put pressure on people's overall finances, which again is going to slow down how much people are spending, which is again pushing that deflationary narrative where the prices will have to come to meet where people are willing to spend. Again, being that weight on even though the Fed is going to try everything it can to push that through. And again, this is rounding out that narrative on new housing starts back to 2007 levels. Again, we had this really slow build out, started to accelerate, and now we've had a huge snapback in permitting and housing. And again, most of these usually take anywhere from, depending on where you are, 6 to 18 months to hit the market, which is why we think 2021 is going to be very aggressive in terms of where we see new volume. And this is, again, that leading indicator that we want to talk about, where it used to be lagging. Now it's more of a leading component. This is where those issues are. We continue to see the stickiness in the fact where people just can't get jobs because there isn't the volume out there. And that's going to be that overhang to how are people spending? Where are they spending? And then again, back to that pushing that velocity of money, where The Fed can continue to print, and as they continue to print, that denominator gets bigger, but people aren't moving that money through. And with that, without people moving the money through, the one on the left, so the chart on the left looks at U.S. consumer delinquency rates. That's moving higher. So as that moves higher, you have the bank's willingness to make that loan goes down. And we've seen that on corporate, on the C&I side, on small, medium, and now large cap, and that is becoming a bigger issue. The top chart looks at mortgage delinquencies, again, only increasing, went up again in August. This is why we've seen this tightness in lending, which again is slowing down that velocity. And the one on the right just looks at the ECB, just showing you this is not a US issue. This is a global problem, which is why when you look at who is the buyer of last resort, when we look in 2008, when the US did this, we had Europe as the buyer of last resort. Then in 2011 through 2014, we had China as the buyer of last resort. Then when we had China coming out and stimulating the market from 2016 to 2018, it was the world that was saying, I'm going to be able to invest in China now. We're reaching the end of the buyer of last resort, and that's going to put that pressure because banks are essentially saying, look, I don't feel comfortable because I can't make money. My balance sheets are already stressed. I'm concerned for where this is going to go. And the central banks have just done essentially everything that they can. And when you look at the law of diminishing returns, the amount that the central banks have to plug in more is just going to continue to weigh down, and the size is going to go up, but the actual GDP effect is going to go down, which again, that law of diminishing returns is going to be a natural weight on where things can move. And when we talk about that C&I or the corporate and the commercial and industrial loans, you can see the tightening standards. This is a huge problem when you consider, well, guys, you already have a ton of debt on your balance sheet. I can't give you more leverage unless you can offset that, whether it's with proof of new revenue, proof of new contract. Are you willing to put that piece of machinery, this real estate, something up as collateral? Because otherwise, I'm sorry, you're not getting your loan. And that's what we're really seeing accelerate, which, the first one was looking at more on the consumer side. But again, this is the commercial side. This is where we're going to see why, in my opinion, why we're not going to see those jobs come back, because people can't invest or borrow to really rejuvenate that industrial or that growth. And that's why when we look at consumer sentiment, this is where things were in terms of, when we look at consumer confidence, things have started to turn a bit. But again, consumer sentiment remains at this low end in terms of where things look. And again, we've had that turn up a little bit, but it's a weird view, which is why when we look at consumer sentiment versus consumer confidence, like where are things going to shake out? And that's why the consumer index, like that consumer confidence is a little weird. And it's one that we want to watch, because could have been a bad data point, or it could have been the way it was, who responded to it at that point in time. But again, we think that lack of jobs is going to overhang and be a bigger weight. Now, in the last quick piece, we're just going to look at, we've talked about the US dollar as a reserve currency and why this is going to be sticky. Now, here you can look at, this is looking at emerging markets. Emerging markets have about 13, to 15 trillion dollars in essentially US denominated debt. And this is non-bank. So this is looking at non-bank debt. Then you can see that just the function. Let's talk about the function of this. So the function is, I borrow in US dollars. Why? Because there's demand for my debt, but it's expensive to do an interest rate swap. Won't go into an interest rate swap, but you're essentially you're swapping one interest rate for a US denominated one. So instead of doing that, I'm just going to make it much simpler. I'm going to give it to you in US dollar denominated, but I am still transacting in my local currency. So that means I have to convert to US dollars to pay you, because I'm taking revenue in. Now, when we look at emerging markets and international markets, when you export, because the US dollar is the reserve currency of the world, as you export, you naturally bring in dollars. So as I bring in dollars, I use that money to pay out my interest. Now, with exports being down, I don't have that natural delivery of dollars. So I have to take my local currency and convert it, or go out and purchase US dollars to feed my interest expense. And as fear is increased, your cost or what you can roll that debt at is getting more expensive, which again is providing this relative bid or protection in US dollar and getting that fear pushing GLD or gold higher. Now, when we look at the backdrop of, okay, well, let's go back a little bit and look at some of these different pieces. This is looking at different debt metrics in emerging markets on a US dollar level. Some of the more fearful ones are the ones that have a much bigger chance of bankruptcy and or default is about 4 trillion. And here you can see kind of who is the biggest owner of non-bank US dollar denominated debt. And again, this is going to be that additional fear because eventually you're going to say, look, I can't pay this. I have to default. And if you default, well, now you have whatever currency you have left, you no longer need that backdrop. So now you can start pushing that into the market. You can start selling it into the market. And then what happens? That shows up at the doorstep of the US. And that can be that natural movement because all of a sudden now the Fed has to absorb all of these new dollars and it's going to create that inflationary spike. Now, will it be hyperinflation? No, we have too many metrics and the US dollar still remains so robust in the reserve currency world, especially because of our Navy and just our military power, which again is going to make this a very interesting dichotomy. But here, the bigger view is there will be some defaults that will increase, which is why I do think there is an inflationary factor that is underappreciated, which is, I think, going to be on a longer term, going to be a headwind for the dollar. I do think the dollar goes to 96, possibly 100 first. And then as it sits up there, now if you think about it, as the dollar rises, the cost increases for the local international consumer because now as the dollar is getting stronger, well, I have to give away more of my currency to meet that, to actually purchase that dollar, which again increases the stress, increases and shortens your runway, which again is why the Fed keeps printing, keeps trying to fill this net shortage. Because if we took all of the principal, all of the interest and liquidated into one payment, we are net short dollars in the world. So again, you're net short because you're assuming they pay until they don't pay. And now you could have a net long, which again would create that issue. Now, these are charts that we've used before, and this really highlights the pressure across these different daily indicators. And emerging markets is a big one because we continue to see this pressure where you had a quick rise, and now we're starting to see some of the demand roll off. We're starting to see some negative data points. And again, it's a bifurcating. Some South Korea had some stronger numbers. India had some weaker numbers. Again, it's just going to be what is the trend? The trend is starting to look a little bit better for South Korea, looking a little bit worse for India. And those are going to be those problems. Like China had a nice little bounce. Again, China's starting to roll over a little bit, but it's within that range. Like we're not talking about rolling over back to 60 like we did in February and March. It's more of that plateau of sitting between 75 and 85 and really not being able to break through again with those jobs overhangs. And that job overhang is going to be really driven based on limited construction, purchasing power, these different entities. And again, this is looking at more of the developed markets. Here you can see there's been also a rollover in terms of the US, France, Spain, and Italy, and this is going to continue to kind of weigh. Japan has been fairly strong. This one doesn't have South Korea. South Korea's gotten a little bit stronger, which is going to provide some of that base, but everything is kind of creating and meeting in this 85% level, which again is why we remain bearish oil demand and inherent refined product demand, because you're just not going to see that moving through. Now, when we look at the FX reserves, again, this is more just to highlight just how big the US dollar makes up on just an aggregate level, even in 2020. Now, countries have tried. Russia, China have actively looked to diversify away from the dollar. What does that mean? That means bring in more gold, bring in more euro. So, but even with that, we're still 60% of the underlying factors, which is why it is not something where we're just going to say, oh, yeah, dump all the dollars and we'll replace it. With what? What will you replace it with? Is it a basket currency? Is it something that is made up of multiple things? Is it more gold? This is why we think that even though there's these weird impacts in terms of how we're playing with the dollar, outside of just you need our Navy. But this is a huge backdrop of why the dollar is always going to maintain that range bound, even though the Fed has tried to push this through, but the velocity of money isn't there, even as money supply continues to grow. Again, not getting into the market. And here's just the final piece that we'll touch on. And we've gone so deep into this. I don't want to waste too much time because we're already coming up on the hour, and you've been great if you've lasted this long. And here you can see the China nearing the end of that debt-fueled run. And we just have this big increase in bond defaults. And this is something that we think is just going to continue to increase because the special purpose bonds really have no actual value in terms of, okay, well, you're telling me I have to invest, but I have no project. I have no means of getting this into the market. So even though the PBOC or the People's Bank is essentially saying, look, you have to invest this. And then the municipality is saying, or the province is saying, look, you told me to invest in 2016. I did. And now all of those projects, or a lot of those projects, are underwater, and I have to finance my debt with tax revenue. So again, tax revenue is already falling because in China, you have the consumer who's still weak, industrial, which still is struggling to get back to where it was. Tax revenue's down. I'm bleeding tax revenue. Where's my money? Where am I going to be able to do this? Which again is coming into pulling some of these dollars forward, finding ways to really kind of shore up balance sheets. And again, we've gone into the Belt and Road Initiative, how this factors in, what the leverage ratios in which we're sit at. I mean, they have about $38 trillion sitting out there in some form of debt, whether under different banks. There's about 8.7 trillion in just the BRI alone. And then you can see the other 32 trillion is within the country itself. So there are huge landmines throughout China. The question is going to be, when do those go off? And I think we're closer to the end than further away, especially given their inability to kind of kick this can going forward. So I thank you for watching this. I hope it was helpful. I know that we went through a lot of different topics, a lot of different terms. I'm happy to take questions, go deeper on specific topics, because again, this is a very broad issue. And this is why we kind of think that even though we've gone through inflation, deflation, US dollar dominance, it's really going to settle out with this stagnation that is going to be perpetual, which is just going to hinder overall economic growth, specifically on the global level. So thanks again for watching. I hope you have a great weekend, or are having a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.